Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Welcome, everyone. This is our Carbon Accounting 101 webinar from CarbonSuite. Thanks so much for joining here. Quick note about the CPE video that just played before. This course is CPE eligible, and it can be redeemed as such. We'll be focusing today on discussing carbon accounting, specifically through the lens of the CarbonSuite built for NetSuite Suite app. So we'll be spending some time going through both the process of carbon accounting and how it works inside the CarbonSuite Suite app there. Thanks so much for joining. Let's go ahead and get started here. So first off will be a little bit about CarbonSuite, myself and Poyen, who are your dual instructors here today. An overview of what carbon accounting is. Take a look at the CarbonSuite Suite app as well, and then we'll save some time for Q&A. Feel free to post comments and questions in the chat there as we go. We'll mostly try to address those at the end, but if there's a question that comes up during the presentation that's quite relevant to the timing, then we'll stop and address it there. Okay. So a little bit of background about myself, one of your presenters, and Poyen. My background is in accounting. It's my formal degree and path of study, and also have experience in sustainability reporting and carbon accounting, with specific expertise in NetSuite ERP. Poyen is our CIO and engineering lead from the CarbonSuite team, joining us as well, mostly more on the product management side and the development, also certified in carbon accounting and sustainability reporting. So today we're merging together concepts of financial accounting and carbon accounting and see how they interact with each other in this emerging field. Thanks.
Hi, everybody.
All right, let's get started. So quickly about CarbonSuite, that's our team here. We are what's called a NetSuite Suite app. And so basically what that means is the Oracle NetSuite ERP platform has lots of extended capabilities to plug in additional software solutions into NetSuite, and that's what CarbonSuite is. So you can think of it as an additional module of your NetSuite ERP account. We do have a global presence. We're serving clients today all over the world. We'll get to the reasons why that is the case and some of these sustainability reporting mandates as well in the next couple of slides. And our team, we are experts in NetSuite and sustainability. So like I said, these financial accounting and carbon accounting fields are beginning to merge together, and we're solving this problem through the ERP system itself. Okay. So starting with just a very high level overview of why we're here. What is carbon accounting and why it matters? So first, why this matters, right? If you've heard of this term before and kind of seen it in your business and maybe in the accounting profession recently, we're seeing that around the world, mandatory reporting on climate and sustainability is becoming the new normal, right? There's regulations that have been passed in regions all over the world, including Europe, Australia, In the US, in Canada, there are regulations emerging as well. And these frameworks are merging together to consolidate together to under one kind of global framework for carbon accounting, which is the GHG protocol. And why did it get to this point? Well, up until today, where the mandatory reporting environment is becoming prevalent, lots of companies were voluntarily reporting on their sustainability and climate data because either their customers were demanding it from them, their investors were including it in their requirements, employees are pushing it up from the ground level. All these different stakeholders are really demanding that companies start to make commitments to reduce their carbon footprint. And what we're seeing and why we say at CarbonSuite that accountants will save the earth is because what this is and how we see it is it's a chance for the accounting profession to take the lead on these topics like climate change and to start to become part of the solution as opposed to just another company that's emitting carbon emissions, but one that's in the participating in the economy that's actually reducing its emissions. So that's why it's important and why it's emerging. But what actually is carbon accounting? So what I have on my screen here is a framework of the GHG protocol, the greenhouse gas protocol. And this is really kind of the standard, the global standard for the methodology of carbon accounting. It's often called greenhouse gas accounting, carbon accounting. They're somewhat interchangeable in the terminology there. And you can think of this as kind of the GAAP reporting framework for carbon accounting, right? It's the standard methodology that every emerging framework uses, and it's the one that CarbonSuite is built on. So what we do within the GHG protocol is we group your company's emissions. So you're a company and you generate greenhouse gas emissions that warm the Earth's atmosphere. And we group them into 3 different scopes: Scope 1, Scope 2, and Scope 3. So Scope 1 is related to direct emissions of your company's operations. A lot of times this shows up in company facilities. Could be natural gas that's in a building that's owned by the company. Could be vehicles within the company's operations that deliver products to customers. This would be your kind of direct Scope 1 emissions. Scope 2 is related to your typically your electricity purchases. So this is energy that's produced by a lot of times the utility company, and you're the direct recipient of that electricity, but you're not the one that actually generates it yourself. So this is an indirect purchase of energy to power your operations. And then Scope 3 is really everything else. So it's your supply chain and what's called the value chain. And this will be upstream activities within your business operations and downstream. So if you look at goods and services that you purchase, right, those, when a new product shows up at your doorstep, that comes into your facilities with embedded carbon emissions already, right? That has to be calculated under the GHG protocol. When you ship that product out on the downstream side, it leaves your facilities with an emissions footprint. It needs to go to the buyer with that same footprint, right? This is more on the downstream side. So Scope 3 is a big challenge, and it has a lot of data to collect within this category. It also includes activities like business travel, waste generated in operations. So really how carbon accounting, what it's doing is it's extending the life cycle of the accounting process from the beginning, the very beginning of the product's life or the service's life, all the way to the end of its life and how it's disposed, right? Traditional accounting is focused more on just the financial activities associated with buying and selling goods and services. Carbon accounting is more interested in the full life cycle of the environmental impact of those goods and services as it relates to your business. Okay. So keep that chart in mind as we go through. That's the GHG protocol, and that's kind of the basis for everything else that we'll discuss on the call here today. Next, we'll look at the overview of CarbonSuite, the Suite app itself, and kind of how we take those principles and put it into our software solution in what's called the Suite app within NetSuite. So our methodology is record, report, reduce. Again, taking principles, record to report is a financial accounting process and language. We're putting that into our carbon accounting framework and including the reduction step, which is really the purpose of tracking your carbon footprint. And it is built for, these are logos of reporting frameworks that I'll get to in just a sec here. But these are the forthcoming or currently existing sustainability reporting frameworks that are in place today. Okay, so breaking it down a little bit, the chart I showed you with scope 1, 2, and 3 emissions, that relates to a process that we call corporate carbon accounting. So if you think about scope 1, 2, and 3, it's all the emissions associated with the activities of your business, right, or your entity. This is your corporate carbon footprint. And how we collect the data for your corporate carbon footprint, it comes from several different sources, right? You'll be surprised that a lot of the data actually shows up on vendor bills. So if you think back to electricity purchases, if you think back to natural gas purchases, waste and water, most of this data is coming through your vendor bills, right? And you need to understand, in the electricity case, you need to understand what the kilowatt hour usage was. In the case of water, you need to understand maybe how many cubic meters of water were consumed at the facility. A lot of that data is flowing through the vendor bills, and this is one of the primary ways that we collect it. As far as data like business travel, expense reports, right? So if you're taking a trip, to a client on-site, or you're traveling for work, you're going to be taking a flight. You're going to potentially be renting a car to drive around. Maybe you're taking an Uber or a Lyft. A lot of that data shows up through expense reports, right? So you submit your report for a reimbursement, and it gets paid out. We collect the data associated to the carbon emissions of that activity, the flight, the mileage for the car, right? Same concept with credit card transactions. Depending on the category, you also have information inputs that can come from surveys of your employees to understand their commuting habits and the transportation typically associated with them getting to the office that contains emissions. And you have vendor surveys as well, where you can collect data from your supply chain and try to understand that purchase goods and services category that we saw in the beginning. Additionally, you can get data from shipments of products, both on the upstream and the downstream side, and we can integrate data from external systems if it's captured there as well. Okay. So that's the corporate carbon accounting side. Kind of drilling in a little bit deeper is something we call product carbon accounting. So we think of the corporate side, it's all about the emissions of the business, of the entity, but we also have the ability to capture emissions at the product level, right? So what happens here within the platform is you can capture the emissions associated with the individual products that you manufacture or that you buy and sell. And what you do there is you actually allocate a portion of the corporate carbon footprint and other different types of transactional data from your accounting or from your ERP system into what's called a bill of materials or a life cycle bill of materials, and that creates a product carbon footprint. I'm not going to spend really any time talking about this today. It's going to be focused mostly on corporate carbon accounting, but just keep this in mind. This is a similar process, but just a slightly different approach. It's looking at individual products instead of the whole company emissions. And then finally, when you get into scope 3, because scope 1 and 2 data, it's quite easy, generally speaking, to collect that data because it's within your company's operations, right? Scope 3 is not. It's in your vendor's operations. It's in your customer's operations. So this is a big change in how we do accounting today. It's considering the whole what we call value chain of the company. To complete the scope 3 part of the emissions calculations. And so this data can come into your carbon accounting process in a couple different ways. I won't, again, spend too much time on this either today. We'll focus on corporate. But roughly speaking, as far as collecting value chain data, You can get it from vendor bills, expense reports, and credit cards, purchase transactions, and you can calculate emissions based on the amount spent. This is kind of our, we call it level one secondary data. It's also called sometimes, it's a high level estimate of your emissions based on how much you spent on the product. That's one way you can do it. Our level two, still secondary data, uses a process that we call industry average data. So depending on what industry you're in, there might be specific called emission factors, emission coefficients that help you do calculations for that particular industry, which tend to be a bit more accurate than the level one spend based. And then finally, the third level is really comes more from these vendor survey and other integration touch points where you can collect primary data directly from your suppliers, and they can help to round out your scope 3 emissions footprint. So usually when we work with clients, we're seeing clients start with a spend-based kind of discovery of their emissions footprint to figure out, based on what I've purchased, what are the hotspots? What are the top 10 vendors that I buy from, and what are the emissions of those vendors? And then start to narrow down and collect more detailed, granular data within those kind of, top 80% of the emissions, for example, and move towards more accurate data collection over time. Okay. All right. A lot of info to get through today, so appreciate everyone sticking with us here. Okay, so we've talked about the different processes of carbon accounting, and really all that comes into a process when we get into reporting of disclosure, sustainability disclosure. So I mentioned these in the beginning. There are several frameworks that are already established and others that are in progress that are actually mandating companies to report data like their carbon emissions. We've got mandates in California that apply to companies starting at over $500 million in revenue that do business in California. The SEC mandate, this one is in progress for US-based publicly listed companies. We've got the EU Corporate Sustainability Reporting Directive. This is a very big piece of legislation that was passed in the EU, and it's actually mandating EU-based companies and companies with operations in the EU to report emissions data, but also lots of other data related to the environmental, social, and governance performance of that business. Additionally, in Australia, they've passed similar legislation that requires companies in different revenue buckets to report this type of data. So what we're seeing, and again, this has really been driven over time by lots of companies doing voluntary reporting. This is what we see in the accounting field and in the regulatory field in general. A lot of times mandates, requirements start as voluntary. So companies kind of get comfortable with the data collection process, get comfortable with the reporting process, and they voluntarily disclose their, let's say in this case, their carbon emissions data. So lots of companies are disclosing to CDP today. There's other frameworks as well that can be used to track disclosures and to track emission reduction targets like the Science Based Targets Initiative. So this push for voluntary reporting and the popularity, and I think, and the demands from stakeholders for companies to report voluntarily has pushed us into this new paradigm of mandatory reporting. So what we're seeing as far as where this work is falling, especially as we get into mandates, and you're talking about disclosure with CSRD that requires lots of environmental data to be disclosed in annual reports, it very closely and quickly gets tied in with financial reporting, right? So financial reporting and sustainability reporting are starting to kind of morph together into one exercise through these mandates, and it's beginning to fall under the office of the CFO, under the accounting profession, and we're seeing that lots of accountants are kind of seizing this opportunity and taking advantage of this and starting to understand, what this reporting requires and to skill up to be able to serve these needs.
Matt, there is a question in the chat. I was wondering if you can take it up now. It's about how will non-mandated companies be affected by the sustainability reporting mandates?
Yeah, that's a great question. So if you think back to the GHG protocol and the scope 1, 2, and 3, what we're seeing a lot is that companies that are not under these mandates, they happen to be in the supply chain or in the value chain of companies that are mandated, right? So here's example, Microsoft, Walmart, these very large companies. They're doing full scope 3 reporting, and they actually include in their supplier contracts that if you work with their company, you need to disclose your emissions. So in various industries and industries where they work with these large companies, they're seeing that they're being mandated to report their emissions as just a general part of doing business. So it's becoming part of the operating rules, really, to win contracts with these big customers. So in addition to the mandates, this is another big driver, I think, especially of smaller companies who are doing this type of reporting, because they're starting to see this as a competitive advantage, and they can win more contracts if they start to disclose this information. It's a good question.
Great, thank you.
Okay, so since I think we've got pretty sure a lot of accountants looking for CPE credit on this call, we're gonna dive a bit deeper into the disclosures, the mandatory disclosures, and kind of talk about what is actually involved there. So first off, the California climate disclosure, like I mentioned, it's starting at companies over 500 million in revenue. That is the SB 261. This part of the disclosure. This is for 500 million and up. And then the other piece, which includes greenhouse gas emission reporting, is 1 billion in revenue and up. They do have a pretty loose definition of what it means to do business in California. And so if you have basically revenue over a certain threshold, I think it's like 750,000 in the state of California, plus you have over 500 million in revenue in the case of 261 and a billion in the case of 253, then you have to disclose under this mandate. This is passed. It's forthcoming in the next couple of years, and companies are already starting to prepare for this because it takes some time to get data infrastructure in place and to start preparing for the mandates. So that's the California climate disclosure. CSRD is a big one. So this impacts EU-based companies, but also international companies that have presence in the EU. Because of scope 3 emissions reporting, we're also seeing companies in the US, in Canada, in other parts of the world that are not Europe, that are being requested for data by their CSRD mandated customers. So you can kind of see how these mandates have wide-reaching effects. CSRD is a bit more involved than the California mandate. It includes reporting on environmental, social, and governance related metrics, as well as reporting on risk assessment related to the business model of the company and the strategy of the company as far as how they're preparing for a world that has a changing climate. So a big piece of CSRD disclosure is something called a materiality assessment. I will not go into too much detail on this today, but basically they're trying, through this materiality assessment, you understand as a business what sustainability related metrics are impactful to your company, both on a financial materiality and an impact materiality. So it's understanding this is a new concept, double materiality. We're assessing, is it material to my business financially and from a sustainability perspective, which is a new concept. So you're seeing how these sustainability and financial accounting are merging and morphing together into one reporting process. That's CSRD. And then quickly, I don't know how many Aussies we have on the call here today. Hopefully a few, but I know it's probably the middle of the night. But we also have disclosure requirements from the Australian government. and similar reporting framework to CSRD, but a little bit less information total. That's information on a sustainability statement. Again, a lot of times this includes carbon accounting, and then information about risk assessment related to climate and transition plans associated with adapting your business to this new world.
Matt, I just wanted to add that I think, so outside of the three kind of major regions that you covered, we do have a sustainability tracker that I'm just sharing in the comments for everyone. There are obviously for other regions, Canada, special, like certain states in the US and other regions. So I'm just going to put that in the chat for people to check out.
Yeah, thanks a lot. Okay, so I'll quickly go through how it works inside of CarbonSuite, and then we'll pivot over and take a quick look at the software itself with the remaining time at a high level. So this is getting a bit more into the technical, how to implement carbon accounting, right? So CarbonSuite is right now just focused on the Oracle NetSuite platform. Again, it's what's called a Suite app. So what happens is you install this Suite app into your NetSuite account, and then we have an engine that analyzes your data, your transactional data in the system, and then it calculates your emissions, scope 1, 2, and 3, can also produce data related to your energy consumption, waste, water, some of these other environmental metrics that are key to this type of reporting. From there, you can generate reports out of the system and really start to dig in and understand what it takes to reduce your emissions. I focused a lot of this conversation on mandates, but a lot of companies that are doing carbon accounting today, especially in the voluntary space, are doing it with the purpose of reducing their emissions, right? So tracking is just a first step, but then from there, it's how do I actually reduce my energy consumption? How do I buy and sell products that are lower in emissions so that I can become a net contributor to reducing global emissions? And then within the app, the kind of key focus is on automation. So collecting this data is one of the biggest challenges, I think, for most companies that are undertaking this today, and they can a lot of times benefit from having an automated solution to do some of the legwork. Okay, so within CarbonSuite, our first step is to set up what we call an emission source. This is effectively a mapping from your financial data to your sustainability data. Again, financial accounting is good at tracking transactions within the narrow boundary of what is financially material. Carbon accounting goes further and it tracks it all the way through the value chain. And so the first step is to set up these emission sources to understand how that mapping actually works in the system. Step 2 is to run the automation. We have a feature called our emission workbench, and what this does is when it's executed, it runs through and analyzes your transactional data in NetSuite, and then it calculates your emissions based on that analysis. And that could be for scope 1, scope 2, scope 3, whatever emission sources you've set up and what you're calculating emissions for. And then the third step is, you're calculating and collecting all of this data. It pulls into reporting frameworks, and we leverage a lot of, for folks who are familiar with NetSuite on the call here, a lot of standard NetSuite, kind of reporting capabilities with dashboards and save searches, analytics workbooks. So you pull through all this data, and you can, put it into reports, and you can communicate this out to your stakeholders. Cool. So again, I know there's a lot of info coming in here today. For a lot of people, this is a brand new concept. And, as we kind of get through the end of the call today, we're more than happy to discuss in more detail any of the concepts that we've covered in the training if you reach out to us, as well as kind of go through a more detailed demo. More than happy to discuss there. So let me actually pivot over and share the application here. So let me exit out of this and get my screen up. It's looking pretty good on my other monitor. Okay, cool. So I'll spend the next maybe 10 minutes or so so we have time for questions and wrap up. Going through a high-level demo of how things work in the system. So like I said, CarbonSuite is really focused on users of Oracle NetSuite ERP platform. Most, I think, accountants will be familiar with ERP platforms, probably a lot with NetSuite itself, but high level NetSuite is an accounting system that also has, tracking of supply chain, manufacturing, inventory management, basically all the modules you need to run your business. So this ERP system is, in our opinion, the best place to start for carbon accounting because it already has vast amounts of transactional data that can be analyzed to basically generate your carbon emissions. Okay. So I've logged into the home dashboard. I'm logged in here as Matt Holden as what we call our carbon controller, right? Corporate controller, financial controller, carbon controller. A lot of the terms in carbon accounting are taken from financial accounting, so you'll see kind of a lot of that overlap. You can see a breakdown of kind of different ways to look at your emissions by different GHG protocol category. Some of the ones you see on here are the ones that are in that GHG protocol chart. You can see emissions by different subsidiary. This would be your legal entities as they're set up in your system, right? Month over month, emissions of your products, things like that, okay? So as you're collecting this data, it all piles into these reports and they're automatically updated in the system there. So I'll next open up the carbon accounting dashboard. Take a look here. Let me see if this will load for me. I think I'm having some bandwidth issues. Let's see if I can get this to open here. Okay, there we go. So your carbon accounting dashboard is kind of the functional place where you're, doing the work to calculate these emissions and following the steps of the automation, right? So coming into our emission workbench, which I think I showed on the screen there before, this is the kind of reconciliation page, right? That's going through your different transactions in the ERP system, and it's calculating the associated emissions. So let's take a look at one of our transactions here. I think we've got one for electricity in Australia. Cool. So what's happening here is we're generating emission, we call it transactions, and we're associating those emission transactions to financial posting transactions in the system. All right. So each bill, each expense report, each credit card transaction, right? These purchases, they'll have associated emissions, and they're calculated in what we call metric tons of carbon dioxide equivalent, right? So what's happening is it's going through into your system with the Suite app. It's reading through bills and different types of transactions like this one here, and it's categorizing them based on those different scopes and those different categories, right? So this is a vendor bill for an energy, like electricity company. It's a monthly utility bill. Pretty straightforward example. What we actually have within CarbonSuite is it's joining the associated carbon transaction to every single financial transaction in your system, and it's passing it on to what's called the carbon ledger, right? Financial ledger, carbon ledger. So in this case, you're purchasing electricity from your utility vendor. We're capturing the financial amount, but we're also capturing what we call the activity amounts. So with a utility purchase, what's relevant for carbon accounting is more the energy that was consumed for that period, for that bill period. So we're actually more interested in the kilowatt hour usage, but it's still associated to that purchase, right? It's still on the same line. So we have functionality in CarbonSuite to either track this data on the line level directly there as the transaction goes in. We also have a feature that can scan through attached PDFs on the bills and pull out this kilowatt hour usage as well, right? So the purpose is to associate what we call the activity data with the financial posting data and generate the associated carbon ledger transaction, okay? let's take a look at another one. So that's an electricity purchase there. Let's go to another page. And how about a purchase? Right. So if we've got lots of different data in here, but this is a company that's in the compute business and they're buying from NVIDIA. They're buying chips from NVIDIA or processors. We actually have the ability from this bill to figure out what the emissions are of the purchase of specific items or specific types of purchases, right? So in this case, we'll open up the bill. We're tying to this specific item. We can understand what the emissions at a high level, a spend-based level, we can understand what the emissions are associated to purchasing $30,000 worth of that particular item, right? So if you think back to those methods that we saw in the beginning of the training session, the financial value, the spend-based approach allows you to capture the emissions based on the amount spent, and it can generate the carbon ledger transaction that way, right? So the electricity bill had the activity data approach with the kilowatt hours. This item level purchase is more focused on the financial spend-based approach. Two different ways to do it, but all kind of consolidate under this GHG protocol framework. Okay. So within a system like CarbonSuite, your goal is to get in the end to your total scope 1, 2, and 3 emissions, right? And you want to do that as efficiently and accurately as possible. So as you install the application, the system's going to go through and make these calculations for you. The data will be pulled through into reports in tons of carbon dioxide equivalent, which is the standard metric. It'll show you the breakdown by categories, by different subsidiaries, locations within your system, and kind of use as much of the ERP existing data as possible to help to manage this reporting for you. Okay. All right. So just quickly looking within the Suite app here, that's a high level look. Again, if you're interested in a deeper dive, we wanted to keep this session focused on kind of the concepts, but if you're interested in a deeper dive session, we're more than happy to help out with that. As far as the reporting goes, you can generate a lot of reports through what are called save searches inside of NetSuite. This is a common terminology. So what you can see is, all the groupings of what are the emissions by my different items, what are the waste, water, and energy generation from my processes, what are the emissions by vendor, right? This is one we can take a look at. So because we're taking this data directly from the financial transactions, you can now see that when the data gets pulled through from the vendor bills, from the credit card transactions, it groups it by vendor, right? So you can see within your system who are the highest emitting vendors and tie this data directly back to the suppliers and the vendors that you're purchasing from and report on it that way. So there's lots of different things you can do with the data. Moving past this and into the disclosure piece, if we think back to CSRD and the California climate disclosure that we had on the screen earlier, your scope 1, 2, and 3 emissions, how you're reducing those emissions, waste, water, and energy, some of these big environmental inputs are key components of a lot of these disclosure frameworks. And usually the most quantitative, the most data intensive to collect in your system. So a lot of times we see companies will start with, as they're kind of getting ready to embark on their sustainability initiatives, they'll start with corporate carbon accounting. They'll focus on scope 1 and 2, maybe scope 3 if they've got the bandwidth for it internally, and then they'll start to build out their sustainability reporting practices and procedures with that baseline as kind of being the most difficult one. So at CarbonSuite, we are able to help out on the carbon accounting piece, the sustainability disclosure, customer specific requirements if you're getting requests from your customers about how to about what your emissions are and disclosures and things like that. This is kind of the starting place for getting into that disclosure mindset. Okay. So again, super high level overview today for the call here to keep focused on the training aspects of CarbonSuite here and kind of the overview of carbon accounting. Okay. I'll pause there for questions and see if we got any coming in from the group here that we can take a look at.
Yeah, Matt, I think there was a couple of questions from LinkedIn. Might make sense to address them now. First one was, who is responsible for carbon accounting within an organization?
Yeah, that's a good one. So a lot of times what we're seeing with clients that we work with is, for sure, companies will nominate at least one person to be kind of the owner of the carbon accounting process. Sometimes companies will have a dedicated sustainability manager or director that owns this process, and they interact with stakeholders within accounting and supply chain and IT to perform this. Other times, we're actually seeing that it's the accounting and finance teams that are the ones that are taking this on. So when we have initial conversations with customers, the CFO is almost always involved in the conversation because, again, sustainability reporting is rolling into the financial reporting process. So we see it, again, as a way for another opportunity for accountants to diversify skill sets and start to learn this new practice because, again, for a lot of companies that are just getting started or just being mandated that don't have access to sustainability professionals, they're assigning this work to the accounting department is what we're seeing.
Yeah, that makes sense. I think with the access to financial data and that being an input to carbon accounting, I think that makes sense. There is another question here. They were more asking about like what are some of the use cases of your customers doing carbon accounting?
Yep. So I'll speak first about let's take one example of a consumer products company client that we have in the UK. They're a cosmetics brand, and they are dealing with an industry that's very focused on sustainability. It's a way of doing business in cosmetics, right? Consumers, buyers are very focused on sustainability. All of their vendors, all their customers request data from them. They've been doing their own emissions tracking for several years now. And what we did with them is they had kind of a solid process around scope 1 and scope 2, but they really wanted to enhance their scope 3 data collection. So we helped them through our process of first analyzing the scope 3 emissions from the amount they spent on their purchases. And then we targeted the top, let's say, 10 to 15 suppliers that they had that were generating most of their emissions and worked with them to collect direct activity data to start to find ways to reduce the emissions from those suppliers directly. So we're working with customers, helping them kind of cover all 3 scopes and get their processes in place. Others we're helping with disclosure. There's a few we're working with that are disclosing to CDP, one of those frameworks I mentioned. This is an annual process where you disclose lots of information about your environmental performance. It's quite time intensive, so we're helping them to automate some of those processes. And then others, again, I think the question was before, what's happening? Why are companies doing this if they're not mandated? That's our other big area that we're working on with customers. They're in the supply chains of Microsoft and Lowe's and Walmart and some of these very large companies that are doing their entire scope 3 reporting. So they're actually being forced through this relationship with their customer to report their emissions and disclose in the way that those customers are requesting. So it's a little bit of carrot, a little bit of stick, a little push, a little pull that are bringing companies into this frame. But again, what we're seeing from our side is a team that's spent a lot of time working in the accounting space and the accounting profession and ERP systems, is that it is a very big shift where this is really becoming part of the daily life of doing business is reporting on sustainability information.
Okay, that's great. Thank you. Matt, I think there's one more last question that I see, and just encouraging everyone to do post your questions in the chat or in the comments section. This last one is, we're a small company. We want to get started. What areas should be focused on first?
Good. So another one that we see all the time, it's a great question. I think the best advice we can give is get started. And whether you're doing that, on spreadsheets or, just, trying to understand your accounting, the data in your accounting system, whether you're working with consultants can be useful sometimes too. Getting started is crucial because you can really start to understand that materiality, the impact materiality of your business processes, and understand what the challenge will be moving forward. I think it takes some time to get systems and processes in place for carbon accounting. You have to train internal resources. Sometimes you have to stand up software systems if that's the route that you go down. It can take some time, and especially as it's more and more likely that you'll be under some kind of either legal mandate or customer mandate very soon. It helps a lot to get started. You can save a lot of time down the road if you get started soon. So for small companies, the best advice I have is just get started. Reach out to us if you have questions. We're happy to. We love talking about this stuff. We're happy to help, and if a software solution makes sense, we can go down that route as well.
Yeah, and then maybe like one last thing that came to my mind is that maybe just focused on starting with your scope 1 and 2, your direct and indirect purchased energy. They seem to be low-hanging fruit, easier to get started with, and then start looking deeper into trying to meet up with the mandates and maybe the downstream value chain or upstream. Just take it step by step, I guess.
Yeah, definitely.
Okay, I'm not seeing any other questions. Just maybe giving a few seconds to see any new ones will come up.
Yeah, sounds good. Again, our contact info is on the screen here. For folks that have joined, if you have questions that you think of later, please shoot us an email here. The information will be posted to our YouTube channel as well. This recording, and I believe the PDF slides associated will go out as well to folks on the call here today. Again, thanks so much for joining. Really appreciate it, and get in touch if you've got any follow-up questions. But from there, I'll wrap it up here, and we'll hope you all have a great rest of your day.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.